Hi, welcome to the Building Wealth YouTube channel. Hope you are doing well today. Well, being transparent is really important to me, so I would like to start from showing you my portfolio. Unfortunately, in Europe, as you can see, we still have to use old brokerage platforms. Unlike US, we don't have many fintech startups with no fees and with easier to use dashboard like M1 Finance, which I really like. As you can see, my portfolio is worth around 16,000 US dollars on this brokerage account, and around 60% of it consists from cash. Here you can also see 100 stocks of Novo Nordisk. It's a Danish pharma company which generates most of its revenue from diabetes treatment. I also have some money on my other account which I will transfer to this account in a month or two, so my total portfolio is actually around 29,000 US dollars. There are also two more charts which I will be showing you, and on them you can see my return on investment compared to S&P 500 performance. This is important because one of my main goals is to outperform S&P 500. On the second chart you can see how much money did I earn or lose in one calendar year. Since I'm trying to save as much of my salary as I can for investment, here it will be easier to see how much did I earn or lose only from investing, not from transferring or withdrawing money from my account. We will be able to discuss more about my portfolio and these charts, but for now let's talk about how to earn money and how to invest in 2020. Since most of my portfolio consists from cash, you might think that I'm trying to time the market. But as many famous and successful investors already said, and as my experience showed me, timing the market is not possible. Just look at the CNBC headlines, where economists said there is more than 60% chance of global recession, and that US is heading for a recession. Those headlines are several years old, and if you would have listened to them, you would sell your stocks when S&P 500 was at around 2,200 points, which actually means you would miss return of around 50% in the next 2 years. Those would be just few of many examples where famous economists wrongly forecasted recession. So the sole reason I am not invested in stocks is because by applying my investment philosophy, I cannot find any attractive opportunities at this moment. Last stocks I had were Apple, which I sold at 220, Skyworks Solutions, which I sold at 100, and JD.com, which I sold at around $36. You can see that I have missed some profits, but keeping those stocks at those prices didn't make sense to me at that moment. I am looking all the time for the companies with good balance sheet, good management, with good moat around their product, and of course good price. The last one is actually the reason I didn't buy any stocks recently. Whenever I find company I like, with good management, good product with moat, that company has huge price, by my standards. Many people will argue that price of those great companies deserves some premium, but I dislike that approach. MasterCard, for example, is a great company with a great product and big industry barrier for competition. But look at the price of the company, PE ratio 43. There is no way I will ever invest my money into something which will need 43 years to double my investment. Of course, PE ratio is not only metric you should watch, but it gives you a good sense of the stock price. We will later go more into how to fundamentally evaluate the company, but for now let's keep it simple. Google and Facebook, for example, whose margins are shrinking, also trades above PE of 30. I'm not arguing about the fact that they are great companies, but for me, even from companies like those two, price is a little bit too high. But we can also see some companies which aren't almost growing at all, trading at big multiples, like Coca-Cola at PE of 28. You can also see that PE ratio of S&P 500 index is at 24, and historically on average it was around 15. That is also metric which shows us how expensive stocks are at this moment, so it is not weird to see that there aren't good picks on the market. To reach historical average, S&P 500 should decrease by around 40%. What also scares me now is uncertainty around coronavirus, because we still do not know how big of the impact will it have to the global trade and global economy. I think most of the people still think coronavirus is China's problem, but in the last few days we have seen huge number increase of coronavirus in South Korea. That is something that could happen in any country. I personally am not afraid of it from health perspective, since its mortality rate is low and we will probably find vaccine sooner or later. But what we do know is that it will have impact on global economy. We just don't know how big it will be. And markets of course hate uncertainty. Several companies have announced already that they will miss forecast for the next quarterly earnings, like Apple and Adidas. Nike also said coronavirus will have material impact on its operations. Company Moller-Maersk, the world's largest container shipping company, warned that coronavirus outbreak in China and quickly spreading across the world would hit earnings this year. Maersk said also factories in China are currently operating at 50 to 60% of capacity. I mean, that is huge impact in short term. So considering price of the stocks, overall condition of the global economy, and all the uncertainties, my opinion is that you should be patient with your investments. I have a lot of companies on my shopping list and I am waiting for so-called event. What I call event is some negative news which will impact price of the stock but will not impact long-term business of the company. For example, Apple fell under $100 in 2014 because financial professionals said iPhone sales have peaked. All of that created panic and great buying opportunity for patient investors. Starbucks also fell more than 20% after one bad quarter where comparable sales in Starbucks stores were lower than analysts expected. And one of my favorite examples is the Walt Disney. Their stock fell hard when Netflix was rising because all media was full of cord cutting and how Disney will lose its TV subscribers. Consequently, stock fell hard to around $90, what gave me nice long-term buying opportunity. Don't get me wrong, I also had a lot of misses. The last one was JD Company, which fell from $50 to $29, but stock kept falling to $20 per share. I didn't end up in slight profit at the end, but the path to it was harsh. This kind of approach gave me ability to beat S&P 500 5 times in last 6 years, so hopefully I will be able to show you its superiority this year too. I am really optimistic when talking about future of the world and the future of the stocks, but price which I am paying has to be good and make sense to me. On the current PE ratio of S&P 500 of 24, it means that companies on average generates a little above 4% return, which is not enough for me to compensate for risks I am taking by buying stocks of some company. If the earnings would be growing fast, that price might be reasonable, but earnings of S&P 500 companies actually declined in 4 out of 5 last quarters on year-on-year basis. All of that didn't make stocks fall. Investors are being irrational at this moment, by my opinion. Stocks are great long-term wealth builders, but that ride isn't smooth as it was in last several years. Maybe new data which will come on next several weeks, like this one which showed us 92% plunge in first 2 weeks of February in China's auto sales, will remind investors that prices of stocks don't reflect situation in real economy at this moment. I personally would rather miss some profits than invest in a market whose price doesn't make sense to me. The best thing I can do is to follow my investment strategy and ignore emotions which I might feel from missing profits or generating losses. Being consistent with your saving, investing and compounding your investment is most powerful force in generating wealth. But the difference between generating 5%, 8% and 12% return on long-term basis is huge. By investing $20,000 on 20 years on these 3 return rates, you generate between $53,000 and $193,000. And on these stock prices, I can't see how your investment will yield those 10% which S&P 500 gave you on average in last 100 years, not to mention 12 or 15%. That would be it for my introduction video. Thank you for watching and please let me know in comments below what do you think about this topic and in what you are planning to invest in 2020. Hopefully, stock market will correct a little bit in the near future and we will be able to find good buying opportunities. I do not like having so much cash sitting on my account and I would also love to show you my decision process and fundamental analysis when buying a stock, which gave me returns better than those which S&P 500 had. Well, have a nice day and I will see you in the next video. Bye!